where smart money flows in 2025. What really causes Bitcoin and altcoin pumps? Bitcoin just crashed from $126,000 to $80,000 and recovered to $90,000 heading into Thanksgiving 2025. Today, I'm breaking down exactly what causes these massive pumps and dumps and where smart money is flowing right now. From October to November 21st, Bitcoin dropped 35%, wiping out nearly $800 billion in market cap. But this wasn't random. Five specific factors created a perfect storm. First, ETF outflows. US spot Bitcoin ETFs saw $3.79 billion in net outflows in November, the largest since launch. BlackRock's ETF alone had a $500 million single day outflow. When ETFs redeem shares, they must sell spot Bitcoin, creating massive selling pressure. Second, the liquidity crisis. Bitcoin correlates strongly with global bank reserves. As the Fed conducted quantitative tightening, bank reserves fell, draining liquidity from the system. Citigroup analysts identified this as the real culprit, not just interest rates. Third, leverage liquidations. Over $2 billion in positions were wiped out, with October seeing $19 billion liquidated, the largest cascade in crypto history. When traders use 10 to 1 leverage, small drops trigger automatic liquidations, creating a death spiral. Fourth, options expiry. $4.2 billion in options expired November 21st, with a put-call ratio above 1.3, amplifying volatility when prices drift far from the $98,000 max pain level. Fifth, macro risk off. Bitcoin now moves with tech stocks, with the S&P 500 dropped 2%. Bitcoin amplified that move several times over as the highest risk asset. So why did markets pump? Four factors: short squeeze dynamics, with funding rates turning negative; rate cut optimism from Fed officials; technical oversold conditions on RSI; and low Thanksgiving volume creating stability. Let's understand the legitimate drivers first. Number one, liquidity flows. The Fed's balance sheet is the single most important indicator. When the Fed expands its balance sheet, money flows into risk assets. When it contracts, money exits. Bitcoin is pure liquidity exposure. Citigroup sees Bitcoin potentially hitting $180,000 in 2026 if liquidity improves. Number two, the Bitcoin dominance cycle. This pattern repeats every bull market. Bitcoin pumps first as the safest crypto. Then Bitcoin consolidates and money rotates to Ethereum and large cap altcoins. Next, mid cap altcoins explode with 5 to 10x Bitcoin's gains. Finally, small caps and meme coins go parabolic, the euphoria phase. Number 3, institutional adoption. ETF inflows create real buying pressure as authorized participants must buy spot Bitcoin. This changed market structure permanently in 2024. Number 4. Technical breakouts. When Bitcoin breaks major resistance levels, momentum buying kicks in. Support levels, moving averages, and RSI drive trader behavior predictably. Now the manipulation you need to avoid. Coordinated pump groups operate through Telegram and Discord. Research identified hundreds of schemes in just 6 months. One group called Big Pump Signal generated 534 BTC in volume from a single coordinated pump. Here's how they work. Organizers accumulate low cap, low volume coins over days. They announce a pump with minutes of notice. Members rush to buy, spiking the price. Organizers sell at a peak using preset limit orders. The price crashes and regular participants lose money while organizers profit. Coins targeted share specific traits. Low market cap under $10 million. Low trading volume. High social media buzz. Few exchange listings. These characteristics make them easy to manipulate. Modern schemes use sophisticated bot networks executing trades faster than humans, often front-running the announced pump time. This is critical to understand. When Bitcoin pumps, altcoins initially dump as traders sell them to buy Bitcoin. Bitcoin dominance rises. When Bitcoin consolidates dates at the peak, capital rotates to Ethereum first, then large cap altcoins. This is phase 2. In phase 3, mid cap altcoins go parabolic with massive gains outperforming Bitcoin. Phase 4 is euphoria. Even small caps and meme coins with no fundamentals pump 100 to 1000x. Bitcoin hit $126,000 in October. Phase 1, Bitcoin leading. It crashed 35% to $80,000 while altcoins fell 50 to 70%. Classic risk off. Now Bitcoin is recovering to $90,000 with altcoins following. We're entering phase 2, but the fear and greed index is still at 15. Extreme fear. We're not yet in phase 3 or beyond. This is early stage recovery. 7 key indicators. Feed balance sheet stabilization in December. ETF flows shifting from outflows to inflows. Bitcoin dominance peaking and declining. RSI establishing higher lows in the 40 to 70 range. Volume increasing with price rises. Fear and greed index moving from fear to greed. And macro environment. Watch the December Fed decision. Avoid pump and dump schemes. You will lose. Instead, dollar cost average during corrections like the $80,000 crash. Layer entries at multiple levels. Focus on Bitcoin first before rotating to altcoins. Research fundamentals, GitHub activity, on-chain metrics, real development. Use technical analysis for timing support levels. Manage risk ruthlessly with stop losses and profit taking. Avoid leverage during volatility. October's $19 billion liquidation destroyed countless accounts. Phase 1, now through Q1 2026, accumulation. Smart money builds positions during this correction, watching for ETF inflows to resume. Phase 2, Q1 to Q2 2026, Bitcoin recovery as liquidity improves with the Fed stopping balance sheet reduction. Bitcoin begins sustained recovery toward $126,000 and Citigroup's $180,000 target. Phase 3, Q2 to Q3 2026, altcoin rotation, Bitcoin stabilizes, dominance declines, altcoins outperform. Phase 4, Q2 to Q4 2026, selective risk taking on mid-caps with strong fundamentals while taking profits. Phase 5, late 2026, distribution, when euphoria returns and the mainstream media covers crypto smart money exits. Simple framework. In risk-off periods, money flows out of small-cap altcoins into large caps, into Ethereum, into Bitcoin, into stablecoins, into fiat. In risk-on, this reserve reverses. New liquidity enters through Bitcoin ETFs first, then cascades down through Ethereum. Large caps, mid caps, and small caps over months. Capital capital rotates predictably. Bitcoin leads, then Ethereum, then DeFi, then layer 1s, then layer 2s, then meme coins. Avoid tokens under $10 million market cap and $100,000 daily volume. Be skeptical of Telegram signals promising guaranteed returns. Watch for artificial social media buzz. Prefer major exchange listings. Analyze volume patterns. Legitimate growth shows gradual increases, not explosive spikes. Trust your instincts. 1000x promises are scams. Bitcoin recovered to $90,000 but remained down 28% from October's high. November 2025 is Bitcoin's worst month since the 2022 Terra or FTX collapse, but every major correction in Bitcoin's history has been a buying opportunity. Smart money is positioned for multiple scenarios. If the Fed cuts rates in December and liquidity improves, we could see a strong year-end rally. If macro conditions remain uncertain, we may consolidate in the $80,000 to $100,000 range through Q1 2026. What causes pumps? Legitimate drivers are liquidity conditions, institutional adoption, network effects, technical breakouts, and capital rotation through market caps. But coordinated pump and dump schemes prey on uninformed traders in low-cap altcoins. The November crash taught us ETFs now drive major price action both ways. Leverage destroys accounts. Global liquidity drives crypto more than anything. Market structure fundamentally changed with institutions. As we head into 2026, watch liquidity, ETF flows, Bitcoin dominance, and macro indicators accumulate during fear. Manage risk. Prepare for the next leg higher. The roadmap is clear. Accumulate quality assets during corrections. Understand rotation cycles. Take profits along the way. Never fall for pump schemes. Subscribe for more analysis that cuts through the noise. See you in my next video about altcoins positioned to outperform in 2026.